Hey, everybody. Before we jump into today's episode, I just want to point out a few ways in which you can work with us here at How to SaaS. Number one, if you're an investor and you're in the middle of a transaction and you want to figure out what is the marketing potential of the target investment that I'm looking at, you can engage with us in a due diligence engagement where within 2 weeks, we can give you a very clear picture of all the levers within the marketing function of that organization for them to drive more revenue and pipeline for the business while being incredibly efficient. Number two, if you're the founder, CEO, operator, or investor of a company where marketing is just under leveraged and it's seen as a growth lever that requires more investment, we can come in and do a deep dive across 3 to 4 months and analyze all the opportunities within that business on the marketing side by looking at demand gen, paid media, account-based marketing, content marketing, product marketing, SEO, website, and much more, and come back with a set of recommendations and a roadmap for what marketing needs to execute against to drive more enterprise value for that business. And number three, if you're the CEO of a company that doesn't have a CMO right now, or there's a gap in the organization because the VP of marketing or CMO was recently transitioned out, we can come in a fractional CMO capacity and partner with you on that business and lead the internal team and the operational plan so that the marketing function continues to make progress and drive more pipeline and revenue. And we'll also help you hire your next CMO by being part of that hiring process and onboard that new person once they're ready to join the organization so that they get a running start. These three types of engagements are some of the most common ways in which investors, CEOs, and companies work with us. And we have a proven track record of driving a ton of enterprise value and revenue growth across those companies. To learn more, go to www.howtosas.com, where you'll get a lot more information in terms of the types of engagements I've described. And you can see case studies and other examples of the work that we've done, so you have a lot more confidence in partnering with us. And with that said, let's get to the episode. Enjoy the show. Welcome to the Private Equity Value Creation Podcast, where we interview leading investors, operators, bankers, and advisors to help you answer one question: how do we increase the enterprise value of our companies? My name is Shiv Narayanan, and each episode I will dive deep with a guest to help you become a better value creator and capital allocator. So with that said, let's jump right in and let's get started with today's episode. My guest today is Craig Jones of TPE Boulder, and what's really interesting about this episode is that Craig and his team invest in much smaller companies than most private equity firms, and they've found that it generates a ton of margin and value creation opportunities for them because there's more room to grow these companies from the ground up, and a lot of the value creation opportunities have not really been invested into inside these companies. So I really enjoyed the conversation with Craig because I find that when we meet a lot of PE investors, they're often running similar playbooks for a lot of their companies, especially when they're more mature. Their cost takeouts or finding efficiencies or running pricing plays or making sales a little bit more efficient. But when you look at companies that are earlier stage, the entirety of the business has not been figured out. And so that's really interesting, right? Because in some ways, you don't really know what the business is going to be when it grows up. And Craig talks a lot about that. And you can explore a bunch of value creation opportunities from the product side to the sales side to the marketing side and everywhere else. So I really liked a lot of the examples Craig used in the episode and how he talks about generating enterprise value for different companies, especially where the founders are pivotal to the business and there's a vertical focus and a bunch of other characteristics that make it worthy of investment. So with that said, I'll leave you to it. Enjoy the episode. All right, Craig, welcome to the show. How's it going?
Very good. Thank you.
Yeah,
glad to be here.
Yeah, excited to have you on. So why don't we start by giving an overview about TPE Boulder and yourself, and let's go from there.
Great. Well, TPE Boulder is a private equity firm focused, here in Boulder, Colorado, and we focus at what is known as the very low end of the mid-market. So Lydia and myself are the two professionals here. We invest in companies that are big enough and profitable enough to attract third-party debt, typically making a minimum of $2 million of EBITDA up to about $5 million of EBITDA, and undergoing majority control transactions.
Got it. And why on the lower end of the middle of the market? There's a lot of PE firms that chase like middle market type of businesses, but tell me about the focus here and what expertise you're bringing to these companies.
Well, it's really twofold. One is that I was a venture capitalist for 20 years, so I know how to deal with small companies and the sort of unique challenges that under-resourced companies face. The second thing is that we feel that the very low end of the mid-market offers the highest return potential. Arguably, it's also riskier. These are smaller, more fragile companies, but the returns have been above the median, even for the mid-market. And one of the major reasons for that, Shiv, is because the multiple expansion opportunity is greater. By that, I mean you're buying in typically for, let's say, 5 times EBITDA, and you're hoping to sell at 7 to 8 to 9 times EBITDA, depending on how robust the market is at that time. So when you add the fact that a small company can grow faster, the rule of small numbers, and the fact that you're getting in at a good price, the upside is excellent.
Right. Yeah, I've heard this from other PE investors that invest down market as well. It's just smaller companies just have more value creation opportunities, and they haven't optimized for a lot of things that a lot of larger companies have. And also there's lesser competition in some ways because there aren't enough PE firms focused on this stage of business.
That's right. I mean, we hope and expect that we can get these companies to the point where they attract the interest of the larger PE firms 5 years down the line. So if we're taking a company that's at 5 million of EBITDA and you can get it to 10 million of EBITDA, you attract an entirely different universe of potential buyers.
Yeah, totally. So talk about your approach to these companies. Like, as you're coming in, obviously you're a smaller firm. Like, how do you look at that? How do you look to generate a return on your investment? And what are some of the value creation levers, or what's your philosophy beyond in terms of value creation for these companies?
Well, Shiv, we rely heavily on 2 metrics that we use as our, let's say, universal screening opportunity. The first is the rule of 40, which we apply across both our healthcare and our software companies. The rule of 40 being the combination of annual revenue growth and the EBITDA margin. And if you're growing 20% a year and you have 20% EBITDA margins, you have the opportunity to continue to scale and do so with organically generated operating profits. The second thing we look at is that rule of 40 against the EBITDA multiple that you're paying to see whether or not you're paying a premium for that excellent performance. So when we look at these companies, they have existing momentum. The existing entrepreneur is doing a good job of growing the company. The question is, can that scaling opportunity continue to happen over the next 5 years? And the single biggest limiting factor in these very small companies is the depth of the management team. They're highly reliant on the chief executive officer, and there are almost always gaps in the next level of management. So one of the things that we do is, a management inventory with the chief executive officer to determine what are the gaps. Do they need a professional vice president of sales, for example? Do they need a chief financial officer or a VP of finance? And identifying those gaps early on and timing the addition. And I say timing because, remember, you don't want to crush the EBITDA, which it's easy to do by adding a lot of overhead in these small companies. So you have to bring in the additional level of talent as it's needed, not necessarily day one.
Yeah. Yeah. I think that's a huge point is that in a lot of founder led companies, the CEO there's a key man risk almost. And so looking at the management side is super important. But doesn't that get tricky because while these companies might be profitable or have rule of 40, they have almost like an operational capacity in terms of how much expense run rate they can handle to actually grow the business. So how do you navigate that in terms of professionalizing the business versus the added costs that might require?
Yeah, so when we're modeling these things out, we add the expenses that are going to be necessary to have a complete management team. So you're going to have operations, sales and marketing, technology, finance, with some level of bench management in it. The second factor is that almost always these companies have a tech deficit. And so we're going to be layering on another level of technology into these companies that is often a year-long project, involves several $100,000 worth of expenditures, both for licenses and initial implementation and training and so forth. And so we will put those in the model. And that's part of the discussion that you have to have with the founder is what is the true EBITDA of the business once these sort of first level expenses are added. So the two sort of tricks to the trade are, number one, you need to give that founder, if you're hoping that he or she is going to continue to run the company for the next 5 years, you have to offer them a second bite of the apple. And our pitch is that the second bite of the apple can and often is bigger than the first bite. So if you're selling 60% or 70% of your company day one, and we have the opportunity to make 5 times our money, if we're successful, you're going to have a much bigger bite of the apple the second time around, and you're going to scale with our help. And so that's trick number one. Trick number two is the question, is that person willing and able to stay for 5 years, or is there a transition plan that is necessary? So in many of these companies, we look for either an internal promote, somebody who has been with the company for a length of time. And sometimes, Shiv, the founder has been running this business for 20 years. They may be tired. They may no longer be full-time involved in the company, even when we get involved, and somebody else is already, in fact, running the company. Or we need to go out and hire a new chief executive officer. So having an honest and open and complete discussion about transition, what that looks like, when it is, who an ideal candidate, all those discussions need to happen up front.
Mm-hmm, mm-hmm. And when you look at that, help me understand that. So when you're coming in and you're having these kinds of conversations up front, like how are you building this value creation plan in partnership with the CEO? Because they may want to transition out, yet the business is kind of dependent on them. And at the same time, you as an investor need them to kind of stick around to see the next phase of the business through in partnership with you, right? So I'm assuming majority of the time that CEO is staying in place. So beyond just the financial side, like how are you working with them to make sure that they are still interested in seeing this through with you as a partner?
Well, Shiv, that's an excellent question. And here, it's more art than science. So there has to be a level of self-awareness on the side of the founder as to what his or her strengths and weaknesses are and what help they need. And if they have an accurate and open assessment of that, then it has the opportunity to be a great relationship. And if they don't, it has an opportunity to be a train wreck. So you really have to assess how well that person's self recognition is. We do a lot of healthcare services deals, and many of the founders are often MDs. They don't necessarily think of themselves as great business people. They think of themselves first and foremost as physicians, they've obviously grown something highly attractive. I always say the hardest thing in the world to do is go from zero to something, and they've done that. And so the question is, can you take this great business that they've built based on the fundamentals? Are you doing something for patients that they can't get otherwise, that is better for them and better for their health, that is reimbursed by some combination of public and private payers or private pay? And can that model be replicated in additional locations? So typically, a physician often is great at everything that they can personally touch. And they may have built a business of scale. They may have built a several $1 million business with even several million of EBITDA, but it's in one location. They can literally touch and feel everything all the time, every day. The question is, how do you replicate that where you're not going to have that daily touch? And of course, that means that you have to have management systems, and you have to have managers in the other locations that are empowered and trained and have access to information and have enough support to be successful elsewhere. So when we've taken companies and replicated them from 1, 2, 3 locations to many more, then you have a opportunity to scale enormously. Remember, this is all organic growth, and the capital expenditures are typically not severe. You're talking about at least some medical equipment. There is some lag time to get up and running in a new medical location. You have to have good real estate. You have to have that real estate be properly certified by the local authorities. You have to have the right physician there, then the support staff for that physician. And so you need to start thinking about, well, what's necessary to create that? Do you need a head of real estate, for example, who is going to be full-time looking for these locations? We have that position in some of our companies. Sometimes it sits under the operations head.
Yeah. And so that makes so much sense. Beyond some of these examples, like what would be the main value creation levers that you're looking at as you're looking at these companies, especially at the scale? Because a lot of PE firms have almost like, I don't want to say predefined playbooks, but it's kind of like a rinse and repeat. Every company kind of has a similar playbook. They look at pricing, they look at sales efficiency. Is that kind of how you look at value creation too, especially since these businesses are earlier stage? Is it more on a custom basis? You're looking at it company by company and trying to figure out what works, or do you have a defined playbook that you're bringing to these companies? And how much does that affect also the companies that you invest in on the front end, based on where you know you can actually help them?
We do not look at companies to invest in where we have to change the fundamental operational effectiveness of the company. What we're doing is scaling the business and making sure that the wheels don't fall off as you grow. And so it's about protecting yourself once you have greater distance, greater scale, multiple locations. How do you have accountability? So you're taking that founder ingenuity, that knowledge about the patients, the knowledge about the payers, the knowledge about the treatments, and then expanding that beyond that initial individual. So it is all about diversification. Diversification by location, diversification by provider concentration. So if we're taking over a company that has significant provider concentration based on that original founder, and 5 years later, we have half a dozen providers, we've lowered the risk for the next buyer significantly. Likewise, if we're starting out only proving the concept in one location, and now we have it in 3 cities. We've diversified from a location standpoint, and that's highly attractive to the next buyer. So rather than looking at it as something where each element of the business needs to be changed, it's more about how do you scale and replicate? How do you take that founder knowledge and expertise and ingenuity and replicate it?
Yeah. Are you having some of these conversations with the founder during the LOI to close phase and saying like, here's kind of how we see this or areas of risk that we need to address post close?
Yeah, I mean, there is a 5-year plan. There's a 100-day plan. There's a clear agreement upon what level of growth is achievable and has a reasonable risk profile associated with it.
Mm-hmm. Mm-hmm. And have deals fallen apart if you can't get alignment on that? Because I'm assuming founders always have their own ideas of how they want to grow the business or what the focus area should be. Like, how are you finding alignment at that phase to ensure that the transaction also happens?
Well, the places where deals can fall apart are include the following. If you're changing states, for example, you're currently in Georgia and you want to go to Virginia and you want to go, each state is a different market in healthcare. And honestly, every city is different. The reason why each state is different is because healthcare insurance is a state-by-state adjudication in the United States. And even if it has the same parent company, the reimbursement rules, the rules on how that specific procedure is reimbursed and the documentation requirements, et cetera, may differ considerably by state. So if you find that the going from state to state causes you to, in your due diligence process, causes you heartburn, then you might say, well, maybe this didn't have the scale that we thought it would have. Second of all, you have to be able to recruit providers in these other locations. And typically, we want to test that out by seeing if we can find people who are interested in the jobs, even if we're not hiring them until closing.
Yeah. That makes a lot of sense. What about prioritization? Like at the scale of these companies, when we look at larger companies, they have a lot more in terms of resources. So they can do cross-sell and upsell as a value creation lever, and they can do pricing, and they can do sales efficiency and overall go-to-market or scaling their marketing efforts. They can kind of do it, and then they can layer in M&A and all of that. But at these smaller EBITDA levels, there are trade-offs. There are real trade-offs and limited resources there. How are you approaching that? Like, what's your process to figure out like what you're actually going to focus on, or where the highest leverage area is for the business?
Well, Shiv, I always tell my CEOs that the most important piece of technology that they have to focus on is the clock. As you point out, there's only so many hours in the day. And if they're at it 12 hours a day, and they could be pulled 1,000 different directions because, oftentimes virtually every employee reports directly to them. So one of the things you got to do is stop that. You got to give the CEO time to be able to think on different dimensions. So the analogy I use is when you think about the clock, think about how much of your time is spent with a microscope, which is what they typically are using 95% of the time. How much of the time are you using a binocular? And how much of your time are you using a telescope? And think of the microscope as focusing on day-to-day activities and what has to be done that day by whom, what employees showed up or didn't show up, what patient has an issue, et cetera. The midterm is what do we have to do in order to accomplish the next quarter's worth of growth? And the telescope is, what are we trying to be when we grow up? What kind of business are we trying to grow? And if a CEO isn't able to spend a significant portion of their time in all three areas, they're going to just continue to be in the position where they're doing the day-to-day 99% of the time. And that's where they were when we met them. And we got to stop that. And typically that means one of two things. You either have to hire somebody else or you have to delegate better. And delegating, as you know, for founders is hard. And they have to, exercise that muscle.
Right. Yeah, I think that's a huge element inside companies because distraction is the enemy, right? So especially when you have limited resources, how can you really focus on the things that really move the needle? And I guess the connected question to this would be, how are you looking at these focus areas and priorities, and how does that connect with your exit strategy and positioning the business for the next buyer?
Yeah. So, if we invest in good markets that continue to be growth markets for the next 5 years, we have every chance to be successful. And if we don't, we won't be. So I've been doing healthcare services deals for 35 years as a venture capitalist and a private equity guy. So I have a very good sense of areas that we want to be involved with. And there's so much happening today that is revolutionizing healthcare. An example, of course, would be the GLP drugs that have just come out that are revolutionizing metabolic healthcare, weight control, and even anti-aging. And so you look at these long-term health trends, obesity and diabetes have been a problem in this country for 25 years and will be a problem going forward. So you ask yourself, what is happening today that could improve the lives of these people? And so an example would be, I'm on a board of a company in Dallas, Texas, called New Promise Neuropathy, that is one of the leading providers in the Dallas-Fort Worth area and expanding elsewhere in Texas to helping people deal with that peripheral pain, typically in the feet from lack of circulation, typically from diabetes. And so this company has a proven protocol that includes electrostimulation and multiple visits that receives Medicare reimbursement. And so by bringing these Medicare patients in for a series of visits, we can start to increase their mobility, which means they are now moving more, which improves their overall health. It is a downward spiral when you're suffering from chronic pain, and that impacts your mobility due to an underlying metabolic disease. And so because I've been investing in and around this space for many years, I know that to be a particular pain point, no pun intended. And so we know that that's a good area to be involved with. So if we execute well, we continue to have the highest standards of medical care. Then the question, and this gets back to your earlier question about the game book, almost always we're going to look for how can we diversify the services. So the asset that we have in any of these companies is access to patients and locations. If we can utilize that real estate and that medical professional capability for a greater range of services, then we have a chance to really ignite the rocket ship. So now you're not just providing pain for neuropathy, but you're also providing some other what other similar problems do these same patients have that we can treat?
How much of this work are you thinking about as you're making the investment and saying, okay, this is the kind of process that we need to take this company through. And also, by the way, if we build this and we build certain assets, it will help us when we need to exit this investment, because there's a certain type of buyer that will appreciate certain assets inside this business that if we scale up, show them a lot more potential or expand our margins or show a higher multiple on EBITDA.
Yeah, I mean, the investment bankers will tell us, look, if you want to attract a, larger fish private equity firm to buy your company and you want to sell at high single-digit EBITDA multiples, you need to show, one, that you've have a bench in the management team. That's the table stake. Number two, you need to show diversification. Diversification by location, diversification by reimbursement code for what you're getting reimbursed for, by payer, so that you have multiple insurance companies that are also reimbursing you. Reimbursement in terms of the number of providers. If you can do those four things, then they're taking on less risk than you took on, and they're going to pay you a higher multiple.
Mm-hmm. Mm-hmm. Yeah, I guess you kind of have to consciously build towards that. And I don't know if all founders are really thinking about their exit story, if you will, right? Because you kind of have to figure out, like, what would a future buyer care about, and what are the types of potential buyers that will actually acquire this business, and which assets do we have that they'll actually value. So I guess you're doing a lot of that work with the founder.
Yeah, I mean, each founder is different. They all have a different sort of set of skills. I would say that the most important thing in these deals is that we have a clean, pristine track record in terms of patient satisfaction, no problems with any regulatory authorities, a clean track record with the insurance reimbursement. Our documentation is sound. If those fundamentals are good, then you have an opportunity to scale the business. If there's a problem in any one of those areas, then we wouldn't want to be involved in the business. So then the question is this a founder who is, just thinking about how he gets some liquidity initially, or is he somebody who also is thinking about the next 5 years? And some are and some aren't. And some can be educated on it and some aren't. I mean, I've lived with investment bankers selling my businesses for 35 years. They haven't. So the question is, are they open to the input?
Right. Yeah. And then if they are, and then you can kind of partner together and start to build a lot of these core pieces together. Yeah. 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 I think that's a great takeaway. Well, and as we're kind of coming up on time here, I wish we had more time to dig deeper, but just as investors are thinking about it, even if they're investing in larger companies or especially smaller companies, what advice would you have overall for them in terms of how they're looking at these businesses, whether it's in the form of the IRR that they can generate or in terms of how they operationally look to create enterprise value with these companies?
Well, I think you want to be in the early innings of these developing medical trends. So I'll give you an example. We invested in a company called Atlanta Fibroid Center, which is the single location interventional radiology center in Atlanta, Georgia, for the treatment of uterine fibrosis. And so you have a patient population, largely African-American women, that are suffering from a real malady that is now treatable in a way that wasn't treatable 20 years ago. But still only a small percentage of women that would qualify for interventional radiology, which, by the way, is an outpatient procedure, unlike a hysterectomy, which is a hospitalization event. So you have the chance to retain fertilization. You have the chance to have an outpatient event, which is much less costly and much better for the woman. And yet, only a small percentage of women who qualify for this procedure are getting it. So we know we're in the early innings. We know that it works. We know that it's better for the patient. The question is, can we take this beautifully run center in Atlanta, Georgia, and expand it to other locations? We're not the only private equity firm doing this, but we have a beautiful model to replicate. So the fundamental question is, are you helping patients? Are you in the early innings of a change? Is this something that is needed, that saves the system money, that is a win-win-win, win for the patient, win for the payers, and still provides a good margin for us?
Yeah, I think that's a really important takeaway, is just really understanding the market and the customers and whether that will continue to hold true. And if it is serving all of these different parties, then the investment thesis in and of itself will be realized. So I think that's a really great takeaway. Before we close off, Craig, what are some ways that people can get in touch with you or learn more about TPE Boulder?
Yeah, so obviously we have a website at www.tpeboulder.com. And myself, Craig Jones, or Lydia Jones, the two professionals here, they can contact either of us.
Excellent. Yeah, we'll be sure to include that in the show notes and all the links as well. And with that said, Craig, thanks for coming on and sharing your wisdom. I thought it was super interesting, especially given the sizes of business that you're investing in. I think a lot of investors that are looking at companies at different stages can learn a lot from it. So appreciate you doing this.
That's my pleasure. Thanks a lot, Shiv.
Thanks for listening to today's episode. Before you take off, just a few requests from our side. Number one, if you haven't done so already, please subscribe to the podcast on iTunes or Spotify or YouTube or wherever you go to listen to your podcasts. Number two, if you are in the market for due diligence services, strategy consulting, or fractional CMO services, please get in touch with us at www.howtosas.com. And third, please buy a copy of my new book, Exit Ready Marketing. It covers a ton of concepts that we take our customers through, private equity investors, B2B companies, CEOs, operating partners, and marketers. And there's a ton of great value in there that expands on my previous book, Post-Acquisition Marketing, as well. So with that said, I hope you enjoyed today's content, and we'll see you on the next episode.